While the world was celebrating silver's historic breakout on Monday, something very different was happening behind the scenes in the financial system. This wasn't trading, it was sabotage. Late last night, under the cover of darkness, exchange officials and top executives from major bullion banks convened an emergency meeting. One fact was undeniable. The free market was about to bankrupt them. Silver had smashed through the $75 mark, and their own models were pointing straight toward $100. They faced a stark choice: take their losses and collapse, or change the rules to seize your gains. They picked the latter. At 3 o'clock in the morning, a quiet notice appeared on the exchange website. No press release, no breaking news banner, no tweets, but its impact was immediate and brutal. The exchange announced a margin requirement increase of unprecedented scale. This wasn't just a regulatory adjustment. It was a weapon designed to force retail traders out of winning positions. They couldn't beat you in the market, so they leaned on the referee to rewrite the score. To understand the full depth of this betrayal, you need to understand margin. When you trade futures on COMEX, you use leverage. You put down a deposit, say $10,000, to control a much larger amount of silver. This system works fine until the banks start losing. The new rule effectively doubled the cash needed to maintain positions. Picture buying a house, signing the contract, and then getting a call the next day. We changed our minds. Bring us another $50,000 by noon, or we take your house and sell it. That's exactly what thousands of traders are facing right now. They're getting margin calls, not because prices fell, but because the rules were changed mid-game. The exchange is engineering a forced liquidation to create selling pressure and keep JP Morgan afloat. But even that wasn't enough to stop the buying frenzy. Reports are flooding in from multiple brokerages that buy buttons are being disabled or restricted. It's the GameStop playbook all over again. Traders trying to open new silver positions are getting error messages: risk management limit reached, or trading restricted to liquidation only. In other words, you can sell silver to the banks, but you can't buy from them. When buying is blocked but selling is allowed, prices only go one way: down. This isn't a free market, it's a controlled demolition. Demand is artificially suppressed so banks can cover naked shorts at discounted prices. This is market manipulation at its most blatant and illegal. Meanwhile, while retail access is blocked, banks are running algorithms to paint a false picture of the market. This morning, huge sell walls appeared on the order book, blocks of 5 million ounces at $76, spooking traders. But here's the truth: those orders were fake. This is spoofing. Banks place massive sell orders to scare the market, then cancel them milliseconds before execution. They never intended to sell. The goal? Create the illusion of overwhelming supply. They're gaslighting the chart, trying to convince you everyone is selling when real demand is surging. It's a psychological attack designed to shake out weak hands. Now let's talk about COMEX. The exchange is supposed to be a neutral referee, keeping the market fair. Instead, COMEX is owned by the same banks it regulates, with board members who are former executives of JP Morgan and Goldman Sachs. When these rule changes hit, the exchange isn't protecting the market, it's protecting insiders. By raising margins and restricting positions, COMEX has violated its duty to the public. They've proven the paper silver market isn't about price discovery. It's a casino where the house shuts the doors when players start winning. COMEX's legitimacy died this morning. They sacrificed credibility to save the cartel. History doesn't repeat exactly, but it rhymes. In 1980, the Hunt brothers drove silver to $50. Banks were on the brink. The exchange intervened, introducing liquidation-only rules. Silver crashed from $50 to $10 in weeks. The same playbook is in use today. But there's one major difference. In 1980, demand was largely speculative. Today, it's industrial. You can't tell Apple or Tesla liquidation only. They need actual metal to make real products. Rule changes might scare speculators, but they cannot stop industrial demand. The banks are fighting physics, and physics always wins. The most damning proof of manipulation is, honestly, the gap between paper and physical silver prices. Banks can smash the numbers on a screen, but, the real world tells a different story. Try buying a 100-ounce bar today. Dealers are charging 40 to 50% over spot. Why? Because the spot price is fiction, a number agreed upon by insiders. The real price is what it costs to actually get the metal in your hands. This proves COMEX is, well, irrelevant. Banks can push the paper price to zero, but they cannot conjure silver into existence. The market has split in two, the banker's price and the people's price. Now, traders need to understand the next escalation step. Deep in the exchange rules is a clause called force majeure. It lets contracts be voided in emergencies. If silver keeps rising despite the manipulation, force majeure may be invoked. The exchange could say, "We can't deliver silver because there's none available. Here's a cash settlement at yesterday's manipulated price." This is legalized theft. It turns your property into a paper claim. They are preparing the legal framework to default, knowing vaults are empty, and rewriting the rules to protect themselves when the run begins. So where's the outrage? Where are the investigations? They aren't reporting the margin hikes. They aren't reporting the shortages. Instead, media outlets are publishing hit pieces calling silver a meme trade and a bubble. This coordinated silence is fueled by advertising dollars. Banks are the biggest advertisers. They control the narrative, keeping the public in the dark. They want you to believe the price drop is natural, not engineered. They suppress the truth as hard as they suppress the price. Because, well, JP Morgan is trapped. They hold the largest short position in commodities history. If silver hits $100, their losses, honestly, would exceed their Tier 1 capital. Put simply, they go bust. This is why regulators are letting them cheat. The Fed knows that if JP Morgan collapses, the entire U.S. banking system could follow. JP Morgan has been deemed too big to fail, and effectively given a license to manipulate the market to survive. We are not just fighting a single bank here. We are up against the combined force of the state and the financial elite. But there is, one player that doesn't follow American rules: China. The Shanghai Gold Exchange operates completely outside COMEX jurisdiction. China watches this manipulation and interprets it as weakness. Every time the West suppresses prices, China accelerates its buying. They are taking advantage of these artificially low prices to drain the West of its remaining strategic reserves. The Chinese government is actively encouraging citizens to hoard gold and silver. They're stockpiling physical metal while the West continues to gamble with paper. By cheating, American banks are, perhaps unwittingly, handing control of the future global economy to the East. They are selling their birthright for short-term survival. These rule changes are also, frankly, enraging industrial giants. Companies like Samsung, Tesla, and Sony rely on futures markets to hedge production costs. When the exchange manipulates prices, it destroys their ability to plan ahead. We're now hearing growing reports that major industrial buyers are abandoning COMEX entirely and negotiating direct supply contracts with miners. This is, without a doubt, a death knell for the exchange. Without industrial users, COMEX becomes nothing more than a casino for paper speculators. The physical market is migrating away from New York, leaving bankers to trade phantom contracts among themselves. The banks made a critical miscalculation. They assumed that crashing prices and rewriting rules would scare retail investors into selling. They expected panic. Instead, they created anger. Social media and trading forums are exploding. Investors are not selling. They are doubling down. Capital is leaving the system and flowing into physical silver, punishing the banks. This is no longer just a trade. It has become a movement, a financial revolution. Every act of cheating reinforces the thesis. They are radicalizing a generation that will never trust fiat currency again. The banks want you to believe they are all-powerful, that they control prices. But frantic rule changes, margin hikes, and spoofing are not signs of strength. They are signs of desperation. A strong entity does not need to cheat to win. Open, obvious manipulation is the clearest signal of weakness. They have lost control of market fundamentals. They are trying to stop the tide with a broom. They can delay the inevitable, but they cannot prevent it. The dam is cracking, and they are running out of fingers to plug the holes. What we are witnessing is the collapse of the concept of a free market. If rules change every time billionaires lose money, there is no market, only a rigged game. This creates moral hazard. It tells banks they can take reckless risks, and if they fail, the rules will change to bail them out. But this destroys faith in the system, and faith is the only thing backing the United States dollar. By rigging silver, they are undermining the credibility of the entire American economy. They are burning down the village to save the castle. Meanwhile, the physical supply crunch is worsening by the hour. Mines are depleting. Ore grades are falling. No major new discoveries have been made in over a decade. Production just cannot keep up with consumption. Above-ground stockpiles are gone, and strategic reserves are being tapped. You know, banks can print paper contracts until the ink runs out, but they cannot print geology. The deficit is real. Eventually, industrial demand will overwhelm paper suppression. When a factory shuts down due to a lack of silver, prices will skyrocket, regardless of COMEX rules. Much of the short exposure exists in the shadow banking system, the OTC market. These positions are hidden from public reporting. This is where true leverage hides. We believe the real short position is 5 to 10 times larger than official numbers. This hidden debt is a ticking time bomb. Rising interest rates and climbing silver prices are making these positions unmanageable. We are, honestly, approaching a Minsky moment for bullion banks, a sudden violent collapse caused by excessive hidden leverage. Despite all manipulation, wealth transfer is still happening. Every ounce of physical silver bought is an ounce banks cannot use to cover shorts. You are removing collateral from the system. They need your silver. That's why they want to shake you out. Do not give it to them. Volatility is the price of admission. Cheating is proof of victory. We are in the final rounds of a heavyweight fight. The opponent is dirty, hitting below the belt, but he is exhausted. One more surge, and he goes down. So how does this end? It ends with the failure of the exchange. It ends with physical silver fully decoupling from paper pricing. A black market price will emerge, double or triple the official number. Eventually, the paper price will be forced to chase reality. Banks will be bailed out by the Fed. Currency will be debased to cover it. And holders of physical metal will be the last ones standing with real purchasing power. This cheating is not a sign the squeeze is over. It is proof that the squeeze has entered its terminal phase. Do not let them steal your future with a rule change. Hold the line. Demand delivery. Empty the vaults. The era of manipulation is ending, while the era of the people is beginning.